It's 2:27 a.m. and I just spent the last several hours preparing this video that I'm just starting to record right now for you guys. Now, let me be very clear. This is not a video I'm looking forward to recording and releasing. I would much rather talk about stocks I'm buying and be optimistic and those sorts of things. But right now we're in la la land. No one is taking anything serious right now. And the information I'm going to give you in this video is downright scary. And I want to take you through everything that's actually going on, what the reality is, because right now we're in a fake situation that no one is really in the reality right now. Everybody's in a dream, it seems like. And it's the reason this is because the market is giving everybody kind of this dream scenario. And so I want to take you through everything in this video. And I'm also going to tell you how I am protecting myself in this situation, which is a very important subject, because after I show you what I'm going to show you in this video, you're likely going to be downright frightened. And if you're somebody that gets scared easily, don't watch this video, okay? You go watch something else, because this one's a scary one. And yeah, let's get into it, guys. It's a big one, okay? This is no normal video here today. So going into years, there's different concerns I have. 2021 was more a speculation concern. 2022 is a concern about the middle class, and I used to use the term middle class could potentially be sliced and diced. And unfortunately, it's exactly what's happened, unfortunately, with inflation. And it was even a running joke for a long time on Millennial Money about, how long until Jeremy brings up the middle class. And in all seriousness, the middle class, I've always said it, they run the United States of America. The only reason all these corporations can make so much money, the only reason the stock market can go up, real estate market can go up, and all those sorts of things is because of middle class. And if the middle class is not doing well, everybody suffers. Everybody suffers. Company profits suffer, real estate suffers, everything suffers. People's wealth suffers. The middle class has to be doing well in order to grow the pie over time. That's just the flat out honest truth, okay? And so in 2023, I have a whole new concern, okay? And it's economic meltdown, not economic slowdown. Economic meltdown, okay? I'm using very specific word choice. This wasn't just like I threw this together. Very specific word choice. Meltdown, not slowdown. Way too many people think economic slowdown, and I'm talking about economic meltdown, okay? The stock market is giving everybody a false interpretation of how things are likely going to actually play out here. And we saw the same exact phenomenon before the market completely collapsed in the great financial crisis. And if you went back to even May of 2008, it looked like the market was going to be okay, and the market was giving signals. The Dow was giving signals that nothing's bad's going to happen here. We're all going to be all right. The economy is going to be okay. Maybe we're slowing down. Maybe we're losing a few jobs here and there, but it's going to be okay. It's going to be okay. And then we crashed straight down in a straight line after that. The S&P 500 did the same exact thing. In May of 2008, it was giving an interpretation that everything was okay in the market, and then we collapsed. And right now, the market is doing the same exact thing. It's giving us signals like, nothing to see here, won't be that bad, right? And it's doing that in the S&P 500. It's doing the exact, look at the Dow. It's not even down that much, right? And it's basically telling us everything's fine. Nothing to be concerned with here. Everything is perfectly okay. Nothing to be concerned with, right? And when you kind of look at all these charts together, right, you got to ask yourself a very important question. Do we have the recipe for this sort of major collapse, crash to happen? And I will take you through exactly, yes, we have a recipe that might even be more dangerous than what we actually saw in the great financial crisis, and that might be the scariest thing. It's 4 steps, okay? Let me take you through these 4 steps, okay? The first one is, we have something we didn't even have to deal with in the great financial crisis. The first thing is inflation. And the reason this is such a big deal, right, beyond this, the ramifications of having inflation in the economy and it being embedded and sticky and all those sorts of things, is the Fed. And unlike the great financial crisis, when the Fed could easily come to the table and help things out, or obviously in the Rona crash, the Fed could come help, the Fed's not coming, and they're not coming anytime soon. In order for the Fed to come, they're going to have to see inflation go under 4%, but ideally, and Jerome Powell said this in the last 24 hours, he said it's got to get down to 2% for a sustained rate, that they're confident it's going to be 2. The only reason the Fed would come to save the day is if, one, inflation was under 4%, but likely under 2%, and the economy was completely falling to pieces. Okay, I'm talking about unemployment skyrocketing. I'm talking about corporate earnings falling apart. I'm talking about just the entire economy falling apart. And outside of that, the Fed's not coming to save us, and they're not coming to save the market. We are on our own. We've been on our own the entire year of 2022, and this is just the first year, and look how that's played out, and look what's happened to the NASDAQ. The NASDAQ's lost over 30% of its value, right? And the rest of the markets held up decent and gave this illusion, right? But going to year two, you're in a whole different dynamic with rates that are a whole different place than the first year, right? So the Fed's not coming to save the day. It's the first thing that's working against us. Second thing working against us is one of these situations. In order to get a major crash, you need a dynamic where something out of nowhere comes and just scares everybody, causes panic, right? In Lehman Brothers and obviously all the ones that went under in the fall of 2008, there was definitely a moment of time, right? You saw mass job losses and you just saw mass fear in the overall financial markets, right? And we have definitely a lot of things that are brewing that are very concerning, right? We've seen what's happened with the whole crypto market, obviously in 22, right? And almost every single crypto company's pretty much went under this year. But crypto is a very small segment of this whole game. There's things that are a lot bigger, and they're in relation to real estate and they're in relation to the stock market, right? And you heard these rumors last week about Blackstone warning of liquidity problems and having to limit withdrawals and things like that. That's just one of those things that's like, wow, where did all this come from, right? And these things can come up from nowhere, right? BlackRock just came out and said, they're the world's largest asset manager. They said central banks are deliberately causing recessions and warns of a downturn like any other that we've ever seen, right? Many experts have already sounded the alarm on the U.S. economy, but you still want to pay attention to what BlackRock, the world's largest asset manager, has to say in a very simple reason. It's predicting recession unlike any other. Recession is foretold as central banks race for the same thing, which is to tame inflation. In fact, the strategists believe that the central banks are deliberately causing recessions by over-tightening policy. Yeah, that's basically what Powell says. I don't know if we really need BlackRock to tell us that. That's basically what Jerome Powell says. He just maybe says it in a more gentle way. I guess we can call it that, right? Kind of like instead of saying, you got fired, it's like, oh, you got laid off or something like that. I guess that sounds better, right? Or you got let go. I don't know. In the past, when the economy entered a downturn, the Fed typically stepped in to help. But due to the cause of the projected recession, right, which is inflation, the central bank can't come to the rescue, which is exactly what's going on here, right? And you got all these potential bankruptcies coming in 2023 that are actually more significant than I think a lot of folks realize. Things like Open Door, things like Carvana. And there's so many of these companies that are almost like zombie companies that are barely staying alive and they're barely staying afloat here in 2022 that look like, unless they can suddenly massively raise money or debt or something like that, it looks like a lot of these companies are going to go under, okay? And this creates a massive problem of ramifications that go way beyond just people losing jobs. Let's say Carvana goes under and they, have to basically cut their entire employee force, or Open Door or something like that, right? That's just one issue. But there's way bigger issues and ramifications and dominoes that happen in a situation like that, right? If you look at a company like Carvana, they owe a lot of people a lot of money, okay? Carvana has accounts payable of over $1 billion. Over $1 billion of accounts payable. That's what's as of last quarter. I wouldn't be surprised if it's higher now, okay? They have long-term debt of $6.6 billion on their balance sheet, which means if this company was to go under, there's going to be a lot of folks out a lot of money. And this is just one company. And we could have a mass amount of bankruptcies in 2023 for tons of these companies, right? And this is just one. I mean, who's taking the hit of billions of dollars? Now, you might say, well, don't they have a bunch of cars that the folks that lent the money to Carvana that they could potentially get their hands on? Sure, but it's not nearly as much as you might think, okay? Carvana supposedly has vehicle inventory of about $2.5 billion, okay? And who knows if that number is even accurate, right? That could be overinflated number. Maybe the real number is like $2 billion or $1.7 billion or something. But yet Carvana has accounts payable of over $1 billion, and they have long-term debt that they owe a lot of folks as $6.6 billion, plus a ton of other liabilities, right? So if a company like Carvana goes under, all of a sudden billions of dollars are disrupted that aren't paid back, right? Which means massive losses for massive amounts of folks, right? And when you have something like that happen, that's just one domino, and then it creates a next domino, and next thing you know, you start to have a credit crunch, which is exactly what we had in the great financial crisis, where all of a sudden, all these banks and folks that loaned money all of a sudden at the same time, we're not getting paid back money. And so next thing you know, the credit market was insanely tight for several years coming out of the great financial crisis. And there was a lot of folks that said, why aren't the banks loaning? No one's lending anything, right? And they were in a credit crunch. And so if you were to see all these companies go under that are barely clinging on to life in 2022, believe me, there's going to be a lot of people out a lot of money, and a lot of banks and institutions that are out a lot of money. And that creates dilemmas for them. Because that's somebody's money that was not paid back. That creates a bunch of other problems. And maybe all of a sudden they have to liquidate something somewhere else, right? Which causes more of a liquidity problem somewhere else. And so you got to understand, when the dominoes start falling the wrong way, it begins to accelerate and rather rapidly in this situation, right? In that Carvana open door situation, right? That's just, like I said, that's just two companies of mass amounts that could be going under in 2023, right? The third thing, in order to have a pretty epic crash in the market, is you need the unemployment rate to start to go up and go up quite considerably. And recently we've had around the lowest unemployment pretty much we've ever seen in the United States of America, pretty darn close, right? Well, what I can tell you is we're already starting to get a lot of the signs that the unemployment rate is likely to start to climb rapidly as 2023 goes along. And it could get really ugly really darn quickly, okay? If you just look at what we've seen in 2022 so far, right? We've seen just tech companies alone in some of the strongest companies in the world start to dump employees left and right, right? Listen, when companies like Tesla, Amazon, Meta, these are the strongest companies out there, right? Even Microsoft, these are some of the strongest companies in the world. When companies like that are starting to cut employees, I'm telling you, it's an early signal that there's a lot of issues out there, because these are sorts of companies that by any means necessary, they will try to hire and hire and hire and never fire in mass like this, right? And so when companies like that are doing it, it should definitely make everybody a little aware of what's going on here, right? We got a lot of other problems here, okay? If you look at the amount of homes under construction, it's an all-time record. People thought we were in a bubble back in the housing bubble, right? Well, I don't think people are even looking at this or even observing this, but we're way past that. We're way past the peak of the housing bubble in terms of amount of homes under construction. We crushed it. And that's not a good thing, okay? So what's going to happen here is new home construction is going to fall off a cliff. And what do you think is going to happen when new home construction falls off a cliff? Well, next thing you know, people start losing jobs in mass, okay? And we're getting proof of this. If you look at Toll Brothers' latest earnings, right? Toll Brothers' new contracts down 60%. The housing market, no one wants to acknowledge this, but the housing market is in complete free fall right now. The backlog for Toll Brothers is already down 21% in terms of amount of homes. That's already? Do you know where their backlog is going to be at this time next year? Probably down 70% year over year, 80%. Remember, we're still early days in the housing cycle in terms of this downturn. We're still very, very early. We're like first inning, maybe second inning at the most. We got a long way to go in that, baby. A long way to go, which is going to mean massive amounts of folks, unfortunately, out of work. Gary Friedman, who leads RH, right, which is Restoration Hardware, which is a furniture company. Same company that basically almost all my furniture is from, the tables and the chairs and everything and basically in this house, right? What did Gary Friedman say on the latest conference call? He described the housing market, this was his quote, as in complete free fall. Gary Friedman is extremely concerned. That man is so concerned that his company's stock price has fallen well over 60% in the past year. And that man refuses to buy his own stock back despite having a share authorization out there because he is so concerned about how bad this downturn can get. And the company has over $2 billion that they could do a buyback with. And the man right now is like, I'm not buying $10 of this stock right now. Even though it's down massively, the stock was $700. It's now $200 something. And that man says, I'm not buying the stock right now because we don't know how bad this is going to get. We don't know how deep this is going to get. When a man like that, that's so intertwined with the housing market, describes it as complete freefall and won't even buy his own stock back despite the fact that it's already crashed, That should be very telling about where the housing market is likely going over at least the next year, if not several years, okay? Now, on top of that, to add insult to injury, we have record amounts of apartments being built right now, record amounts of warehouses under construction also, simultaneously, right now, okay? Right now. So basically, here's what I'm here to tell you. It gets no better than this. This is as good as it will ever get. It only gets worse. It only gets worse, okay? The amount of homes under construction is going to go down. The amount of apartment buildings under construction is going to go down. The amount of warehouses that are under construction are going to go down. And what that means is people are going to lose jobs because the next group of massive amounts of homes to be built aren't going to be there. The next massive amount of apartment buildings to be built aren't going to be there in warehouses. And all these projects were funded on cheap money when the Fed had rates at zero, okay? And now everything's starting to dry up, and it's drying up fast. And so all this backlog as 2023 goes along, all these homes are going to get finished up, all these apartment buildings and warehouses, and guess what? There's going to be lack of new ones coming, which is going to create a massive dilemma in the construction field, okay? And when it comes to the construction field, this is as good as it gets right now, okay? The construction field employs almost 8 million folks right now. Is it hard to imagine that by the end of 2023, there's 1 to 2 million jobs lost in the construction field? I don't think it's out by any stretch of the imagination. I don't think that's impossible. I think that's very, very realistic, unfortunately. And like I said, there's no one's coming to save the day. The Fed's not coming to save the day. The Fed's not coming to drop rates to zero tomorrow. That's just the bottom line. And everybody go buy homes and let's go build a ton more apartment communities in warehouses and things like that. It's not happening. So the numbers in the backlog is just going to get worse and worse and worse. And those electricians and those plumbers and those framers and this and that and this trade and this trade, right? Those guys aren't going to have the next job. And that's just a bottom line. And so all that work will just dry up more and more and more as the year goes along, and they will get uglier and uglier and uglier for all those fields, right? And if you're talking about that, you're talking about manufacturing is going to get hit too. There's no way manufacturing makes it out of that. And it's like, manufacturing's fine. No. Manufacturing has basically been in decline for decades in the United States of America. And yeah, it has a little revivals when the economy is doing well. But at the end of the day, when the economy starts getting hit, manufacturing is going to get hit. And when you talk about if there's going to be a lot less homes being built, guess what? There's going to be a lot less cabinets being built and a lot less refrigerators sold and just everything else that goes into a home, right? That could create massive amounts of manufacturing jobs in the United States of America when you got all this stuff being built everywhere, right? And so this is going to end up playing out as the year ticks on. And is it impossible to see 1 to 2 million jobs lost in manufacturing by the end of 23? I don't think it's out of the stretch of imagination at all. And when you start adding up these tallies, next thing you know, you got 2 million jobs lost, 3 mil, 4 mil, right? The numbers get bigger. And if you're talking about a lot of people starting to lose jobs and unemployment going up, right, which is exactly what the Fed wants to see and needs to see, then you're going to lose jobs in leisure and hospitality as well. You know how many restaurants barely make it each month? Literally, if you were to go around any major city in the United States of America, or basically anywhere in the world, the amount of just restaurants that barely make ends meet, in that if they just lost a few extra customers a week or all of a sudden losing money, it's a pretty long list actually, unfortunately, and it's sad, right? And so you got to understand, if the economy starts to hit, you're going to start to see restaurants going out of business. And all of a sudden that restaurant that, had 5 or 10 employees doesn't have any employees anymore, right? And they aren't paying that lease for that strip mall, place they had before, right? And so next thing you know, those folks are out of money. And so this is the problem. This is the dilemma of when you start hitting the dominoes the wrong way, which is just what we've just started to play out here, okay? Is it just leads from one thing to another thing to another thing, and it just starts bringing down everything. When the economy is getting better and better, and people are getting more jobs and making more money, and inflation's at a normal pace, right? It's great because it just creates more and more jobs, and people can do more and more things. But when you start getting into contraction and scarcity, it just leads to more and more contraction and scarcity until finally you break out of that cycle. And usually you break out of that cycle because the Fed comes in and helps. But the Fed's not coming in to help anytime soon, unfortunately, okay? The fourth thing you need, and then we'll talk about how I'm going to protect myself in this whole situation, is you need earnings to tank. especially of the Dow type stocks, right? The S&P 500 stocks and the Dow type stocks. And based upon what I just took you through, first off, every single one of these companies basically is very concerned about 2023. Basically, almost every single company I ever listened to a conference call, they're extremely concerned about what's going to happen in the economy in 23. Every CEO is very scared. I mean, very scared. And if CEOs and CFOs are scared, what do? Contraction, scarcity. It's a natural human instinct, right? And that's what you're taught as an executive. And so is it impossible for those companies' earnings to tank? No, not at all. If what I just laid out for you starts to play out, guess what? All these companies are hit. Goldman Sachs numbers start to get hit. Home Depot's numbers start to get hit in a major way, right? McDonald's could maybe even potentially get hit. Microsoft, Caterpillar. All of a sudden, these companies, right? Visa, maybe the amount of transactions going through starts going down. In terms of their revenue starts downtrending because the economy is getting in a worse place, right? And then the oil and gas stocks start to get hit because, as we know, as a recession actually starts to come, the oil and gas stocks all tank, right? And so are there's many people buying iPhones and iPads and Macs and all those things if this recession starts to play out and unemployment starts to climb massively? No. And so next thing you know, all these earnings start to tank for companies. And this company was supposed to have 10% revenue growth, and now they have negative 10% revenue growth, right? Which means their EPS is down 25%, 35% or something like that, right? And so I don't think it's out of the stretch of imagination to imagine all these companies have their profits and their revenues actually go down in 2023 if that scenario plays out, right? Now, in terms of protecting myself, okay, so there's a lot of things I could do, right? One is I could sell out of all my stocks. Well, we know I'm not one to just sell my whole portfolio and be like, I'm out of everything. No, because at the end of the day, maybe everything I just laid out doesn't happen. Maybe we just keep building record amounts of homes and record amounts of apartments and record amounts of warehouses and everything's just great and everybody has record earnings and it's a beautiful, beautiful thing, okay? But I don't think that's going to play out. And so, but I'm at the same time not the type of person that's going to be like, I'm dumping all my portfolio and all my stocks. So what I'm going to do is I'll protect myself through an instrument. And basically what this instrument is, it's called SDOW. And it's basically, kind of like a 3X against the Dow. So imagine the Dow goes down 2% in a day. Then SDOW should go up approximately 6% in a day. And so basically it's just a 3X inverse on the Dow. So if the market tanks in a massive way, SDOW it basically is going to go up in a massive way, okay? Now, for me, since I'm looking just for protection and I'm not looking to play this for long term, I'm looking to put things on, let's just call it a higher level, okay? So what I went ahead and did in the past 48 hours is I bought call options on SDOW, which is basically a bet that, and once again, this is just a hedge, right? And it's a small hedge. So just in case the market tanks, I'll make a small fortune. Let's just call it that, okay? And I bought $23 strikes call options, and I bought $50 strike call options. So if the market tanks, SDOW is going to go up in an epic way because, even these gains can kind of compound over time, right? And so let's just imagine a scenario where, in the first 6 months of 2023, the market just absolutely just crashes, right? The Dow crashes for the first 6 or 12 months or whatever, right? Obviously, next thing you know, SDOW would be $50, maybe $70, maybe in a pretty bad downside scenario, maybe SDOW is like $100+. And then in that scenario, obviously, these will be extremely profitable. But my hope is, and this is my hope, that those options expire completely worthless. That's my hope. I don't want to make any money in those because if I made a bunch of money in those, that means the economy likely tanked and the whole market likely crashed pretty darn bad. So it's protection for me just in case the stuff hits the fan, as they say. And that's what I'm doing for myself personally, and that's kind of where I'll leave that. And so will I still be a buyer of stocks in 23? Absolutely. And the lower stocks go, the more I'll be a buyer. And if you see me all of a sudden like, hey, I'm buying $50,000 of this stock and $70,000 of this stock and $100,000 of this stock as the market crashes, you'll know where I got the money from. It'll be from that SDOW. Okay. So anyways, that's the game plan there. And that's kind of what we got going on. It's unfortunate, but it is what it is. And you got to deal with what you got to deal with in life. Appreciate y'all. Much love as always. And have a great day.